Hi, I'm Stephen Dooley, Head of Market Insights at Convera, and I'm really glad you're able to come along and hear the findings from our Are You Ready for 2026 report. I'm joined here today with Shirley Lim, our lead FX and macro strategist based out of Singapore. Shirley, thanks for joining the call.
Delighted to join you, Stephen.
Fantastic. Really looking forward to presenting to you all today. The Are You Ready report, of course, is our yearly report. We've been producing this for a number of years, and we'll be looking at the key major themes in 2025, how they'll translate into 2026, some of the drivers and how that will play into the economic and FX landscape into the next year, and then finishing off with some considerations for global businesses. But before we start, for any of you not familiar with Convera, we are a global leader in commercial and cross-border payments that power international businesses. The organization has more than 40 years industry experience. We have top payments and fintech talent, more than 1,900 experts and growing. You can see some of the numbers there on the left-hand side. We make payments into over 200 countries and territories in over 140 currencies, and we work with over 900 educational institutions, 50 global banking partners, and over 700 law firms. So we've got the global scale, the local knowledge to be able to help your business. And the kind of businesses that we work with include small businesses, SMEs, large corporates, financial institutions. We power the FX and commercial payments for many financial institutions. We have a dedicated offering into the legal and payroll space. We work closely with the non-governmental organisations to get money to remote locations. And as I mentioned earlier, we are the provider of choice to educational institutions, some of the most well-known university and educational institutions around the world. But as I said, what we do with the Are You Ready report is really think about some of the key global themes that drive financial markets. And of course, this year, it's been pretty clearly obvious to most observers that trade wars were the dominant themes in financial markets. The news around tariffs drove major FX swings in 2025, most notably the move in the euro that we saw in the first few months of Donald Trump's presidency. Before Donald Trump took office, the assumption was that the euro would be particularly hard hit. We saw the euro US dollar fall from 110 down to 101, a 10% fall. But after Donald Trump took office, his focus was actually more on Mexico, on Canada, and the euro had a massive rally from 101 up to 119 in the first 6 months of this year. So a 30% round trip in a little over 6 months demonstrates the kind of volatility we saw in financial markets as a result of this tariff program. But what was interesting is that in 2025, it was very different to what we saw in the first sequence of trade wars in 2018 and 2019. Those trade wars between particularly the US and China saw the focus really in Asia. But this time around, Donald Trump's tariffs were so wide-ranging and so much larger that the impact was felt right across the world. But what's interesting, it wasn't just a negative impact. Yes, we saw the Canadian dollar underperform. Yes, we saw the Mexican peso underperform as a result of those tariff threats. But some of the currencies we saw really outperform, like the euro, like the British pound, were mainly because they are very trade exposed economies, but also saw less impact from those tariffs. So the euro, the pound, big winners. And if you're making payments into the UK, into Europe, you would have noticed how much more expensive goods cost as those currencies increased. What's interesting is that in 2025, some of the currencies that were hit hardest by that first series of trade wars in 2018, 2019, the Aussie, the Chinese yuan, were less impacted. And you can see that why in that lower left-hand square, these are the economies that have relatively small trade exposed sectors of their economy, even though they might be big exporters, the rest of their economy is much larger, or they might be less exposed to the US. And you can see here South Africa, the Australian dollar, the Chinese yuan, relatively performed relatively well despite the tariff noise in 2025. So again, some of the planning that businesses might have put in place might have been upended because the way markets reacted very different from that first sequence of trade wars that we saw in 2018 and 2019. But while tariffs were the headlines in terms of how governments impacted financial markets in 2025, doesn't tell the full story because government spending continues to grow, and as it grows, it's having incredible impact on financial markets, particularly in interest rate markets. And you can see here where the current rate of the respective 10-year bond yields, those benchmark yields, right at the top of the range over the last 10 years. And that's because government impact is being felt by much bigger spending programs. And some of those spending programs are a result of major seismic changes, increased need for defense, changing demographics that's causing more in welfare payments, but also because of these COVID era spending programs that governments are finding it hard to wind back. And that's probably most clearly seen in the UK as the new Labour government struggles with trying to end some of these COVID era spending programs. But it's also seen in the US as well, where the One Big Beautiful Bill has continued to enlarge government spending. We saw similar stories in France and in Netherlands as well. So as governments spend more, they're causing they're increasing the size of their debt load, and that's flowing through into interest rate markets as well. So government impact more pervasive than ever. And of course, I guess most traditionally when we think about the government impact in financial markets, it's been that geopolitical impact, and that remains front and center. And in fact, probably more so than ever. And it feels like the last 10 years has seen more and greater geopolitical shocks. There's a reason for that. It's because there is. And if you have a look at this chart here of the last 40 years, it tries to map out geopolitical impacts. You can see that we've had big long periods in the 90s, in the 2000s, in the 2010s, at least the first half, where the size and the frequency of geopolitical shocks was extremely rare. However, since 2015, we've seen a shift, and it hasn't just been, as I say, in those traditional geopolitical areas of wars and terrorism, but think about economic fragmentation, the Brexit vote, the trade isolation, the US-China trade wars, the rise of protectionist policy. So as financial markets try to deal with more frequent and larger impact geopolitical events, what we see is a sort of stop-start pricing, a quick reaction, and then a move back to normality. And that's creating more volatility in financial markets. And again, that flows into the kind of sudden price moves that we see in FX markets. That said, the government impact has been absolutely huge. But another really key theme over the last year has been that sharp fall in the US dollar and concerns over whether the US dollar really remains a safe haven. And so I'll pass on now to Shirley. And Shirley, who led the research on this topic for the report, will walk us through. So, Shirley, over to you.
Sure, thanks, Stephen. So let's shift to one of the most discussed stories of 2025, the US dollar's surprising weakness. This year, the dollar fell about 9% year to date, which naturally lays questions about its status of as the world's safe haven currency. What's fascinating is that this decline wasn't just of any deep problems with the US economy itself. In fact, while the dollar was falling, US equity markets were hitting an all-time highs and economic growth remained robust. So what really caused this? According to the for International Settlements, the central bank to central banks, the driver was a significant increase by hedging activity by international investors. So essentially, global investors became more cautious about future risks and started hedging their dollar exposure, even while staying invested in the US assets. This is unusual, but not unprecedented. In both 2008 and 2016, we saw similar breakdowns in the dollar's safe haven appeal. Markets were nervous, the dollar weakened, but as soon as the uncertainty passed, the dollar recovered quite quickly. So the key takeaway here is that while the dollar can lose its shine temporarily, it tends to regain its footing while the dust settles. So yes, the dollar is on trial right now, but the jury is still out on whether this is a lasting change or just another chapter in the currency's long history of resilience. Now let's address the hot topic of de-dollarization. There's been a lot of noise of countries moving away from the US dollar, especially with the rise of new global alliances and digital currencies. But the reality is actually more nuanced. De-dollarization is happening, but it's a very slow process. There is simply no real replacement for the US dollar today. When we do look at the global reserves, alternatives like the euro, the yen, and even currencies from the BRICS bloc, Brazil, Russia, India, China, haven't gained meaningful traction. The major issue is that these currencies lack the stability, liquidity, and global trust that the US dollar commands. And this is where the phrase, Tina, there is no alternative comes in. Despite all the political noise and the push for alternatives, the world keeps coming back to the US dollar. Even in times of American political turbulence, the dollar remains the currency of choice for trade, reserves, and international finance, simply because other currencies are viewed as riskier or less accessible. So now let's look at the euro, which many thought could seize the opportunity to challenge the dollar. While the euro had a strong year, it remains as a challenger, not a champion. The eurozone's fragmented bond markets, relatively low share of global payments, and internal political challenges makes it really hard for the euro to take the top spot. As Winston Churchill once said, democracy is the worst form of government, except for all the others. The same can be said for the US dollar. It's the least bad option among global currencies, and that's why it remains at the center for the global system. So really, to summarize, one, the dollar's fall in 2025 was driven by hedging, not by a loss of faith in the US economy. Second, the de-dollarization is happening, but alternatives are far ready to take over. And third, the euro and other major currencies remain challengers, not champions.
Thank you, Shirley, and really good, great insights that you've put together for the Are You Ready report this year. The final theme we wanted to talk about was how central banks who set interest rates and impact hugely on currencies are really facing a new era of monetary policy. The central banks are under attack, and of course, last year, the most obvious example really has been US President Donald Trump calling for lower interest rates, attempting to remove a board member, a Fed board member, Lisa Cook. So that's been the obvious headline there, but it's actually deeper than that. And we mentioned earlier how government spending is rising, impacting on bond markets and market interest rates. Well, as central banks look to set those interest rates, they're increasingly conflicted because as they raise interest rates, it impacts on debt payments and makes it more unsustainable for governments to service that debt. This chart here really shows you clearly that the US federal deficit, now the largest it's been at any time outside of a recession. And this is a sign that we're seeing right around the world. Governments are spending more, they're finding it hard to wind back their spending, and that's causing impact on bond markets. But in this case, it's also making it tougher for central banks. And one way that we're seeing that translate, for example, is from the most recent finding from the US Federal Reserve at their Jackson Hole Symposium, asking the intellectual shift, do we have to get used to higher interest rates because governments are spending more, creating more demand, and increasingly causing interest rates to push higher over the very long term. That said, in the short term, it also looks like interest rates might be pushing higher. And this shows you the waxing and waning of interest rate policy over the last 10 years. Of course, you can see that interest rate cuts around the world fell to a bottom during early 2020 as a result of the COVID crisis. We had that burst of inflation 2 years later. Central banks raised interest rates to a high. And then as inflation paused, central banks cut rates once again. But you can really see the momentum in central banks here. And this is the net policy moves according to rate cuts and rate hikes. You can see that appears to have reached a bottom at the end of 2025. In 2025, we've seen the European Central Bank essentially end its rate cutting cycle. We've seen the Reserve Bank of Australia also say that it might have ended its rate cutting cycle. In the US, concerns around inflation means that maybe the Fed doesn't have that many rate cuts to come. And so as we look into 2026, that potential for the rate cutting cycle to turn means that we could start to see rates moving higher, particularly initially in bond yields, but then after that, as a result of central bank moves. Now, this is important because historically interest rates have been the key driver of foreign exchange rates. The golden rule in FX was always that higher interest rates meant a stronger currency. But we can see that disconnected this year, most notably in the US dollar. In blue, the key 2 year interest rate differential between the US and its trading partners. In light green, the US dollar. And it disconnected this year. Now, Shirley already mentioned some of the reasons, that pickup in hedging, but some of the other reasons were a result of concerns around central bank independence, the ability of the US to pay its bills during the US government shutdown. So these factors are essentially lumped in as the foreign exchange risk premium. And as growth differentials, interest rates become less important, then forecasting foreign exchange becomes more difficult. And so that's why looking at this new era of monetary policy really tells us that forecasting foreign exchange as governments impact, as there are uncertainty around the US's reserve status, shows you that trying to forecast foreign exchange becomes more and more difficult. And that's part of the reason why when we put together our foreign exchange forecast, we rely less on a single number endpoint, but a scenario basis. What might happen in some circumstances to drive the currency lower? What might happen in some other circumstances to drive the currency higher? And we'll explore that right now as we pass back to Shirley to cover the economic and FX outlook. Shirley.
Yeah. So now let's zoom out and look at the broader global economic outlook. Despite all the turbulence, trade wars, government debt battles, and geopolitical shocks, the world economy has proven remarkably resilient. For 4 consecutive years, global growth has averaged above 3%. So what really supports this resilience? First, you have your low unemployment. In most major economies, people have jobs, which keeps consumption and confidence pretty high. Second, you have your subdued inflation. After the inflation spikes of the early 70s, price pressures have eased, helping restore real income and stability. And third, you have your interest rate cuts to date. Central banks have generally been cutting interest rates, spurring growth and keeping borrowing costs manageable. But of course, as what Stephen alluded to earlier, the theme will be potentially a pause or higher rates for next year. And we also can't ignore the risk. Rising unemployment and renewed trade tensions could disrupt this positive momentum. These are the things to watch as we head into 2026. Now, looking ahead, global growth is expected to remain supported into 2026. One of the key drivers is the expected rebound in North America, particularly in the US, thanks to policy initiatives like your One Big Beautiful Bill, which is boosting fiscal spending and economic activity. Asia, however, faces a different set of risks. The region is more exposed to tariffs and trade frictions for certain countries. And if tariffs escalate further, Asian growth could slow significantly. On the other hand, if Asia proves more resilient than expected despite this risk, there'll be positive surprise for global GDP. So the message here really is one of cautious optimism. The world is finding ways to adapt, as we all humans do, but trade and employment risks remain front of the mind. So in summary, slow and steady wins the race. The combination of low unemployment, contained inflation, and supportive fiscal policy means the global outlook is still constructive. But we are in a more complex and unpredictable environment, so flexibility is really crucial here. So the key takeaway is first, global growth remains resilient, but watch for volatility and new risks. Second, the US dollar's future path will be shaped by risk sentiment and macro fundamentals. And of course, we always have to stay agile and alert to both downside risks and upside opportunities.
Great. Thank you, Shirley. So, how does this all translate into FX markets? So, as I said, we have a scenario-based approach to foreign exchange forecasting. And I'll explain why. The Australian dollar US dollar pair, one of the more volatile currency pairs, historically over the last 40 years has traded in an 18% range each year. So that translates to about a 13 or a 14 cent range. So a move down to 62, a move up to 76 is actually extremely common. In fact, it's the norm in the Aussie US dollar pair. So that's why looking at our forecasts each year, we start off with the baseline. Well, what will happen if the currency market moves around 18% per year? So that said, while our forecast for most markets is for the US dollar to press higher, that isn't the case in the Aussie dollar because we expect to see the Reserve Bank of Australia remaining cautious, less likely to cut interest rates. That is supportive. And also, as Shirley mentioned earlier, expectations that if Asia and China can improve, despite the risks, that should be supportive of the Aussie dollar. So as we look towards the end of 2026, we have a target of 68 on the Aussie dollar. So that's about a 5% increase from where we are now. The range from between 66 to 70. But then, as I said, what could drive the market higher or lower? Well, to the downside, tariffs remain the big risk. That's what pushed us below 60 this year. And further bad news on tariffs would push the Aussie dollar back lower again. On the flip side, an easing of tariff tensions or improvement in global growth or Chinese growth in particular can help the Aussie dollar break 70 and move into those mid 70 levels. The New Zealand dollar is in a similar set of circumstances where we do expect to see that to rise. Partly that's because this year has seen the New Zealand dollar really underperform. It's been one of the hardest hit currencies, and that's because they've been cutting rates so rapidly over the last 12 months. Really, because the New Zealand economy has been continuing to disappoint. We think as the Reserve Bank of New Zealand ends its rate cutting cycle, that can provide support to the Kiwi, pushing it back up towards 63 by the end of 2026. That said, the New Zealand economy has continued to disappoint. If it disappoints further, the RBNZ might be forced to cut further, and that can weigh on the Kiwi. That said, an improvement in global growth, an improvement in New Zealand growth can push it back above that 65 level that we have in the core scenario, and an improvement in New Zealand growth after 18 months of real underperformance would boost the New Zealand dollar. Shirley, why don't you run us through some of the currencies you're looking at in Asia?
Sure. So now let's turn to Asia with the Chinese yuan. Looking at the current fundamentals, China is still grappling with weak domestic demand, significant property sector stress, and persistent deflationary pressures. Policy support is expected to cushion some of the weakness, but the yuan will likely remain range-bound and sensitive to further negative shocks. And looking at the central case scenario, if China's government support measures succeed in driving a genuine recovery, we could see a more stable or even slightly stronger yuan. On the downside, if PBOC delivers a larger than expected stimulus of the US dollar could weaken and also the CNY could actually strengthen. On the upside scenario, if PBOC becomes more tolerant of a weaker yuan, or if its geopolitical unrest intensifies, CNY could face renewed downside pressure. So now let's turn on to Singapore and the Singapore dollar. Recent strength in Singapore's data was largely due to one-off surge in pharmaceutical exports. The broader medium-term outlook remains more subdued. The MAS is expected to keep the policy steady with growth and inflation below trend for the next few years. Sing dollar, however, remains a regional safe haven, as you all know, and valued for its resilience and predictability, than delivering outsized returns. So for our central case scenario, if global growth remains lackluster, Chinese growth stays sluggish, Sing dollar is likely to remain at this current level, supported by Singapore's stability. On the downside, if the Fed is forced to cut rates rapidly as US economy slows, US dollar could weaken and Sing could rise. And of course, conversely, on the upside, if we do see a global sell-off or renewed risk aversion, the US dollar could gain traction against the Sing dollar as investors seek safety.
Fantastic. Thank you very much, Shirley. Great analysis, and thank you for walking us through that. So, in conclusion, for our customers, stakeholders, what do we think businesses should be thinking about as we go into 2026? Well, currency volatility is here to stay. Sudden moves of 5-10% are likely to continue. So think about what you should be doing to manage that risk, whether it be geopolitics, whether it be a recovery in the US dollar, whether it be unexpected moves in bond markets. We will continue to see FX volatility. So thinking about ways to get on the front foot and manage that is going to be critical. Second of all, we already mentioned geopolitics, but it's not just the impact on FX markets. Think about how it can cause businesses to be forced to move to new locations or to change up trade corridors. We've seen that really significantly over the last 10 years around that deglobalization, that move away from China, the China plus one, moving into new Asian areas, the growth that we've seen in Mexico. So, we can help you when you think about how can you set up or implement payments into new regions. We're the global experts in this. And then finally, sanctions. We've seen that increasingly over the last 10 years as a result of that increase in geopolitical risk, as a result of more interventionist governments. So this remains critical. So think about the efficiency of your payments, the security of your payments. This is how we can help you. So reach out to your customer relationship manager, your account manager here at Convera. We will be able to help you. Of course, you can get access to the full report on our website. You've got the details here. So please, I hope you find it useful. I'd like to thank you all for attending and watching today's webinar. Like to say thank you to Shirley for presenting today. Really great presentation. Feels like you've had some practice doing this. And thanks again for everyone for watching today. Really pleased to be able to help you with the findings of our Are You Ready for 2026? Thanks, everyone.
Bye.